time frame question was how to decide which time frame is controlling the market. Simplest way to understand the time frame, okay, simplest way is first to identify whether there is a range in the market. Right now I can see that there is this range developing. No matter whether you are trading daily chart, 30-minute chart, 1 hour chart, 5-minute chart, or 10-second chart, or a weekly chart or a monthly chart, does not matter. Logic remains the same. One more thing, all this is usually referred to as time frame. Many people come and ask me, Dean, I want to be an intraday trader. What time frame should I select? Shall I trade on 30-minute time frame or 5-minute time frame? This is not the correct definition of time frame. These are not time frames, alright? When you go to this chart and you see this, all these different ways of plotting the charts, these are chart periodicities. These are not time frames. So what are time frames? Time frames are the amount of time you are going to hold your trade. Time holding a trade is called as a time frame. So simply, if I want to trade intraday, my time frame is intraday. If I want to trade short swing trades which last for 3 to 4 days, I am a short swing trader. That is my time frame. I will be holding for 3 to 4 days. If I am an investor, my time frame is as long as I can hold a stock. Make sense? If you are trading BTST or STBT, okay, many traders do that. These are not intraday traders because they are holding the trade beyond the day's trading duration. They usually come into short swing trade. So if it is greater than 1 day, it is a short swing trading time frame. Alright? So this is how you define the time frames. Now let us try to answer the question is how to find out which time frame is controlling the markets. Now obviously you know that every trader has a different time frame. Everyone wants to hold their trades for different durations. Everyone have different price objectives, and as many number of traders are there will be as many number of time frames. So how do we decide which time frame to follow? So for that we need to find out the dominant time frame. The dominant time frame is the time frame that is controlling the range. Okay. So I have this range right now. The low formed here. There was a resistance. So we had the upper end. Before this confirmation, we already had the upper end of the range. And it was confirmed here. So now how many confirmation points we have? 1, 2, 3, 4, 5, and now we are again approaching the top. So we have almost 6 confirmation points. Now we know this is the dominant range. Now, the dominant time frame is the one trying to maintain the range, right? How do you maintain the range? When it comes to the top, you sell. When it comes to the bottom, you buy. Those traders who are buying at the bottom of the range and selling at the top of the range are the dominant time frames. What do we call them? We call them status quo time frame. What do we mean by status quo? It means they will maintain what is happening in the markets. They are going to maintain the range. That is the status quo time frame. That is the dominant time frame. What is the use of this? The use of this is now you can define 2 more time frames. 1. The time frame which will be responsible for a breakout or a breakdown of this range. Whenever you have a nice balance and you break out from it, what you are actually trying to do, you are trying to find a new area to balance again. You can see here, balance, discovery, balance, breakout, balance, breakout, balance, breakout, balance. It will continue. Why I said the word discovery is because once you have an area of balance and you want a new area of balance, there will be a discovery process. Either it will go higher or it will go lower. Okay. Here the balance was happening at the top. We went lower, again went higher, got rejected, and finally found the area to balance. So this down up down was the discovery process. So I call these time frame as discovery time frames, and always remember discovery time frames are higher than status quo time frames. Now you have 2 time frames. Status quo, which is trying to maintain the range, discovery, which is trying to break out from the range. And there is one more time frame which I called exhaustion time frame, and that is smaller than status quo time frame. And these time frames are responsible for whatever is happening inside the range. Okay, whatever is happening inside the range. You see exhaustions at one of the end, exhaustion time frame is active. You see some trends, you see pullbacks, you see consolidations. Whatever is happening inside the range is controlled by exhaustion time frame. In other words, range within the range, the smaller range which is happening inside that particular day, that bigger range is controlled by exhaustion time frames. Alright, now you have 3 time frames, and how are you going to use them to find a trade? So market goes higher, it forms a nice consolidation, tight balance and breakout. This is going to be your support. Why? Because this is a HVM. Market goes higher, gets rejected, forms the top. Now you have a bottom and a support and a resistance, or bottom and a top of the range. Now you can draw this range, project it in the future and expect it to hold or break, and that will give you a trading opportunity. Now you see here, what is expected when you reach the bottom of the range? You reach the support, demand is expected, market should go higher. It reaches the close to the top, supply is expected, market goes lower. Comes again to the bottom, demand is expected, market goes higher, again gets sold into. Make sense? So this range is holding. When you go to the top, supply is coming in. When you go to the bottom, demand is coming in. But now see what happens here. Right here in these 4 days, we, instead of getting rejected from the top of the range, we are spending time at the range. We are moving sideways near the range, near the top of the range. Instead of getting rejected, we are moving sideways. This is called as spending time at the top of the range. This is unexpected behavior, right? What do you expect when you are in a range? If I go to the top, supply should come in. If I go to the bottom, demand should come in and prices should follow. Demand comes in, prices goes higher. Demand comes in, prices goes higher. Supply comes in, prices goes lower. Supply comes in, at least it gaps down and then again recovers, but it goes lower. But here, instead of going lower towards the bottom of the range, we are moving sideways. This is unexpected behavior. Now, this expected, unexpected behavior in different situations, they happen a lot in the way I analyze the markets, and I call it the sixth sense of market. Alright? When you want to understand the market at a deeper level, you need to first address what is the expected and unexpected behavior. So in this case, the expected behavior is resistance and support at the top and bottom. But here, instead of going lower, it is just moving sideways. This is unexpected behavior, and what follows is a breakup. Top, all-time high probably. What is expected when you go there? Supply. Do you think the market is falling from here, or is it moving sideways? This is unexpected behavior. What follows is a breakup. Now, coming back to our time frame example. The range is being maintained by the status quo time frame. Now, forget about intraday, forget about daily, forget about long swing, short swing, forget everything. Find a range and then understand that this range is being maintained by a certain group of traders, that is the dominant time frame. Okay. Now, if you are taking 3-4 days to travel the range, it is short swing time frame. Or it is taking more, it is taking a couple of weeks from one end to the other end, it is a long swing time frame. Make sense? If you are looking at a 30-minute chart or a 5-minute chart and you see a range, that is obviously intraday time frame. Make sense? So what you need to find out is that what is the dominant time frame. So here the status quo time frame is dominant, it is maintaining this range, and now you have unexpected behavior. Now what you know is that the discovery time frame is fighting with status quo time frame. On all previous occasions, they were not fighting. Okay, at the top, supply, fine. At the bottom, demand, fine. They were not interested in trying to break out. What were they doing all that time? They were accumulating their positions in the middle of the range. Supply comes in, they will buy slowly on the way down. Again, supply comes in, they'll buy slowly on the way down. When the market is going higher, there is an intraday pullback, they will keep buying. They'll keep buying in the middle of the range. And then when their absorption is complete and they know that supply is not as strong, they will start to push the boundaries. This is called as absorption of supply. because it's at the top. If it happened at the bottom, it was absorption of demand, and you get a breakout. So instead of trying to find out whether the intraday time frame is active and short swing, forget about it, find a range, and that is your dominant time frame. Let us see if we can find it in an intraday chart. Market is going down, fine, and then over the next few days it forms this range. Okay, now you can see obviously there are these HVNs to give you the top. This is the bottom, then the top is respected, bottom respected multiple times. All right, top resisting, again pushing the market lower, and here what happens, you see market breaks out and it's not rejected back inside, it is moving sideways. There is a small consolidation here, and that is called as absorption of supply. So now when you are trading this chart, I don't know how many days have, these are 4, 5, 6, 7 days, but there is this range. Okay, there is this range, and when you go to the top of the range, supply is expected, and when the market reached the top, you can see instead of getting rejected, it spent a lot of time. On all these occasions you got rejected and moved away from the bottom, away from the top, but here it did not move quickly. Then slowly it went lower and then it broke out, and when it broke out and it started forming a micro balance here, that is where you knew that it was absorption of supply and we are likely to go higher. Make sense? So this happens on all time frames. This happens on all time frames. Now this was a 4, 5, 6, 7 day range. You can find an example on intraday too. Okay, so let us look at this. This is a very small range, right? It's continuing till this point. Every time you see, you go to the top, supply comes in, bottom, demand comes in. Finally at this point you can see we do not get rejected, we do not go lower, we do not break the VWAP, and we have a range and we are right at the top of the range. Again, possible absorption of supply. Now we are looking at a 3-minute chart. We looked at the daily example, we looked at a multi-day example, and now we are looking at a 3-minute chart and intraday example, and it works on every time frame. Make sense? So who's the dominant time frame here? How will you define it? Whether it's intraday or swing trader? No need. Range is maintained by what? Status quo time frame. Now if it is to be broken down, absorption of supply or demand has to happen, and that will be by discovery time frame. It will give you a tradable move. The size of the range will give you an idea, like okay, it is consolidating for so many hours. You might get at least half the time the market should trend. If this range is, let's say, 20, 30, 40, whatever, 50 points, it will move at least that much, 50 points or maybe a little more than that. Make sense? So this is how you can use a dynamic approach to time frames instead of a fixed approach.